So data analytics was earlier about 3-4 years back, I think. That was a buzz. So you always keep on your toes, isn't it? And in COVID scenario, who could really sustain? Who could adapt very fast? Someone who could adapt to the new requirement, new technologies very fast. The same thing. There is a huge disruption that happens in our lives once we leave our active working life and become retired. So once we retire, keeping ourselves active is very, very important. And to keeping ourselves active, it is not about just working. Many people, what they do is they retire, and after the retirement, because they get bored, they again end up going, taking up the retainership or go for the work post retirement, and they again slog with a lot of stress with that work. But it's always good if you can develop a new skill, some teaching skill, um, some blogging skills, or some hobby, develop an hobby, music, something which you can pursue after your retirement. That is very important for your happy retired life. Second is regular income, because currently what is your regular income currently? It's your salary, isn't it? But post your retirement, will your salary would be there? No. But will your expenses stop? No, expenses are always regular. They will not stop. They will always be there. So when your expenses would always be there, you need to start planning in advance so that by the time you retire, there is an alternate source of income other than your business income or your service income. And the third and foremost would be estate planning. So estate planning means how would you transfer your wealth that you have earned to your future generations. Now, estate planning involves, first thing would be writing down your will so that there are no fights of your kids in future. Once you are not there, there is no fight. So writing down your will. Second would be ensuring that the nomination is always updated, whether it is your bank, whether it is your life insurance, whether it is your PF account, NPS account, everywhere you have to ensure that you have updated the nominee details. If your demat account, everywhere you have to ensure that you update your nominee details and keep reviewing it on a regular basis. So lack of nominee detail is again one of the major reason. What happens is post a person's demise, his family becomes handicapped in getting their hands on their parents' earn. So how many of you would like to fall in that scenario where you are no more there and your kids, instead of mourning for you, they're actually struggling to see that how the wealth that you have earned for them passes on to them. So these are the three major areas where each one of you have to plan. So why retirement planning? Tell me why do you think you should plan for your retirement? Quick answers. Why do you think you should plan for your retirement? No answers. Happy ending. Mostly we hand over to kids for peaceful life for self and family. Okay. So these are the benefits of if you plan your retirement. Okay. Now, why retirement planning? Let's look at what are the major reasons which require you to plan for your retirement. First and foremost is increasing life expectancy. Any guesses in 1960, what was an average life span of an Indian? Any guesses? In 1960, I'm saying about 60 years back, decades back. 60. I love the wild guesses you have been making. In 1962, this is the data from the World Bank. Okay, so it's not my created data, it's a data from the World Bank. In 1962, the average lifespan of Indian was 41, and across the globe, it was 52. In 6 decades, that is 60 years now, okay, it is 69, and the global average is somewhere around 70 plus. Okay, and by the time you retire, in next 20 years, 25 years, this lifespan is going to increase. It's going to increase. So there's a misconception. I see many of my friends speaking about, yaar, zindagi bahut choti ho gayi hai. Boss, you have not seen earlier. Earlier, about 6 decades back, people used to be fortunate. There were like families where they used to have 10 kids, 12 kids taking birth, and there used to be only 4 or 5 who actually become adult. And out of that 4 or 5, only 1 or 2 would be old. That used to be the condition in India. And in that scenario, there was no requirement of retirement planning because people never used to retire. People used to die while their working life itself. So in India, our working life is what? We are very active till at least 60. Forget about 40s, 50s, till at least 60s. Even after 60 also, we have seen our grandfathers and all still being very active. So that is one of the major reasons that if you retire at 60 and say your life expectancy is somewhere around 75, 80, or even 90. 90 is not a distant dream. It's also very possibility because the advancement of medical technology. What is happening is people are not healthy. We are no more healthy, isn't it? We are not healthy, but still we are very sure we will not die easily because there is a lot of medical advancement, a lot of medical technologies that will ensure that we stay alive. And there is a lot of research that is going on. So humans are going crazy about seeing that how their life expectancy can be increased. The target is 100 years, 100 years by achieving. The target is by 2030, the life expectancy, it should be made possible that any human one should live 100 years. That is how things are going on. So if that is the thing, then what would happen? Obviously, the healthcare costs are going to increase because we will not be so healthy because of our sedentary lifestyles, no matter how much we try to. Okay, we are not going to stay healthy, but at the same time, we will be alive. And to keep ourselves alive, there will be a lot of healthcare costs that we will have to be spending on. Then there is a disruptive business environment. So you never know when you will be forced retired because we have seen in IT itself, let us see, since 2008 to 2020, in the last 12 years, there have been 3 downturn cycles which IT has seen from recession till now. There have been 3 downturn cycles. First was recession. Second was a global impact of again the recession that happened, the second wave of impact, and third is a COVID. So we have three downturns in IT industry itself. Not only IT industry, global economy itself we have seen, where in every phase many people have lost their jobs. And even now, what has happened is many people who are like 50 plus, 55 plus, or 60 plus, they have been forced to retire. Even in the company which I used to work earlier, they made a mandatory that everyone who is 55 plus should be retired immediately. They were forced retired. So the disruptive business environment. So you need to plan for your retirement. And last but not the least, the newer expenses. Tell me, someone would have planned for his retirement about 20, 25 years, isn't it? Like today, your retirement is 20, 25 years away when you're starting planning. Someone would have planned about 20, 25 years. Would he accounted for internet bills? Would he accounted for digital streaming like Netflix and Prime, Amazon Prime subscriptions? No, they would have never planned for it. And is it a discretion? No, it is a mandatory now. Can anyone stay without an active internet connection? No. Is it possible for us to not subscribe to a Netflix? At least one of the OTT platform we will be subscribing it, isn't it? So was this all planned earlier? No. So there will be even same this kind of newer expenditure also would surely come 20, 25 years later, which we cannot foresee even today. So we have to even inbuild that. So these are the major reasons why one should plan for his retirement. So the next question is, okay, I'm ready, Rajesh, I'm ready to plan for my retirement, but how much should I plan? So tell me, what do you think would be enough for your retirement? Yes, I was expecting Chirala, Mahimitra Chirala. I was expecting this figure, 1 crore. I don't know. People feel that once I'm a crorepati, I'm wealthy. Isn't it? Sudhir, 3 crores. Okay. What else? Any other? Only 2 crorepatis here? No other crorepati? After deducting inflation, 1 crore. Nice, tricky answer. Okay. Might require more or less. Yes, that is what. How much more, how much less? Someone said we cannot. Yeah. Anshika, we said we can't know beforehand. Yes, Anshika, no problem. No. Yes, you can't know beforehand. Yes, no issues. But at least you can reasonably calculate how much you may require. And one of the major thing I really love, people saying keeping inflation in the view. Yes, keeping inflation in the view, how much you would be requiring. So here's the table, quick table, keeping the inflation rate at 6%. Okay, keeping the inflation rate at 6%, depending on your age. So whatever may be your age, I will not Ambaraz, you were asking your age. Okay. So by the way, my age is about 38. So somewhere I'm closer to 40. Okay. I would say 35. Let me. Okay. So closer to 40. So if I have been at 40, if I'm spending 1 lakh now, okay, by the time I require at 60, it would become 3.21 lakhs. So what you need to look at is based on this chart. Okay. Based on this chart, uh, if you want to please take a screenshot of this chart immediately, not an issue. So based on this chart, you can reasonably calculate what your, so whatever would be your today's spending. Now, how you are going to calculate your today's spending? So see, for example, presume that you have retired today, And if you are retired today, what is going to be your retirement expenditure? Plan for everything. What is going to be a retirement expenditure? Like if you are still in a rented house, plan for your rental for your home rent. Um, Plan for your other expenditures. Don't plan for your kids expenditure, because by the time you retire, you need not pay anything to your kids. The kids will take care of their kids. Okay, so don't plan for your kids expenditure. Yes, in addition to all those plans, what you need to top up is top up by about 10% for your medical costs, and then again top up by 20% for your non-planned expenditure. So some future expenditures which you may be required to spend out. Okay, so ultimately we'll have to top up. Say for example, your calculation comes to 70,000, so you will have to top it by about 30% to 95,000. And once you're topped up to that, based on that, you calculate that what would be a monthly expenditure 20, 25, 30 years from today, based on your age. So I presume your age is between 30 to 40, not more than 40. If it is more than 40, then again you can just try to adjust it based on the numbers. So now this is about the monthly expenditure, how much I require. Now, if I'm saying this is my monthly expenditure, then what should be my corpus that would generate this amount of monthly expenditure? So obviously the next question would be that. So what should be my retirement corpus? So going with the same example, that you would require, that you're 30 today and you require 1 lakh for your lifestyle, because even if you plan for your international holidays and everything, I think 1 lakh per month is not very high number. So if you require 1 lakh today, and if you then you would be requiring 5.74 lakhs by the time you become 60, 30 years from the now, the minimum retirement corpus that you should target. The minimum is to ensure that you have a very good, decent lifestyle, and the maximum is a lifestyle which you can, like, you need not worry about. Like, you want to go for an holiday, you can go for an holiday. You want to do something, you want to give for your grandchild, you can give for your grandchild. Anything that you can do. So the minimum 20 times and the maximum 35 times. So if I go with the calculation, the minimum 20 times is 20 into 5.74 lakhs, that is per um, month my expenditure into 12. So 20 times of my annual expenditure. So 5.74 into 12 into 20. So how much? 13.77 crores. Did anyone even thought about this number? किसी के सपनों में भी ये नंबर नहीं आया होगा, isn't it? And if it is decent, 25 crores. Now you may get astonished at this number and say Rajesh has gone crazy. Sorry, boss. If you think I've gone crazy, then please go and call your grandfather immediately after the session and ask your grandfather, okay, Dada, what was your monthly expenditure when you were 30? If you are 30 today, ask your Dada what was his monthly expenditure when he was 30. And just proportionately calculate that what is your today's monthly expenditure and what was your Dada's monthly expenditure and how many times it has increased. Okay. I think most of you would have heard saying that in our time we used to get it at 1 paise. In our times we used to get it at 2 paise. Okay, even I tell my kids that our time we used to get 50 paise chocolate. Today for them, chocolate means minimum 5 rupees. So 10 times, isn't it? So this is what. So this is what the reality of life is, and the reality of money is. So now tell me, are you getting ready for your retirement? Have you started planning for your retirement? And if you are not, please start, because the earlier you start, the easier your journey is going to be. And the later you start, you see how steeper it is going to be. So it is always about planning early so that it becomes very smooth. So how can you plan? Ensure that at least 20 to 30% of your monthly income you invest in such a way that it goes for a long term requirement of your retirement, and you need to keep that in mind. So today what happens is most of us are more so concerned about buying a home. Okay, isn't it? The first and foremost, I think, I don't know, it's a big craze or a big fancy that the moment you start earning and your earnings become good enough, I think it crosses like your family income. If you and your spouse both are earning, the moment that it crosses about like somewhere around a lakh, people start thinking about let's go and buy a house, because it becomes so easy to get a home loan nowadays. Home loan is the most easiest thing to avail today, and especially for salaried employee, banks are behind them to give home loans. Okay, but frankly speaking, what I always personally, it's my personal feeling. Please don't get offended. I always personally feel that the home should be, you should buy a home only when you can buy a home at least 60 to 70% of your home amount you can pay it from your pocket. And I personally believe you should buy a home when you have at least the entire money as your own net worth. Like if I have to buy a home of 1 crore and already I have my investments of a crore, then I would think of buying a home. Of course, no matter, I may plan, even at the time, I may plan to go for a home loan, saying that, okay, home loan is available at 7%. I can still invest the same amount and earn more than 7%. Okay, so that can be my rationale for going for a home loan. I'm not against taking a home loan, but I would always plan my home when I have got the money equivalent to my home already as my net worth. That is my personal philosophy. Okay, yeah. So what happens is the moment you go for a home loan, your major focus always shifts to paying your EMIs. So when you're only focused today on paying your EMI today's, tell me how can you focus on your future requirements? So somewhere they always get blurred. But when you become conscious of your future requirement, you start balancing, saying that okay, out of the 1 lakh which I'm earning, 60 or 70,000 is my for my current and short term needs, and next 25-30,000 I will always save for my long term needs. So quickly write down in your chat window. So what's your plan for your retirement? So what do you start? So how do you think you will start planning? I don't say you would have ready-made plan, but what you would start planning for your retirement? Start posting into the chat window. Whatever comes to your mind. So how are you going to think for your retirement? Invest in regular income, investing 25% in mutual funds, continuous investing in stocks, NPS, PPM, home with rent, stocks, investing in LIC and SIP, invest in stocks and real estate, SBI retirement and mutual plans, home with rent. Okay. So let's see what are options do we actually have. Okay. So Warren Buffett said that never depend on a single income. Make investments to create a second source. And in fact, I would say you should always invest into multiple avenues where you get multiple sources of income. So you should never be dependent on a one source, even post your retirement. So you should have multiple sources post even your retirement. And why we should need for a multiple sources? Because I think we have already discussed this. So let me skip this. So what are the options that we have? So many people who are conservative, they believe investing into fixed deposits. Now, investing into fixed deposits, I'm not saying whether it is a good or bad, but at the end of the day, what is the return that you get onto the fixed deposit? You get somewhere around 5.8%, 5.5 to 6%. Now, 5.5 to 6%, which is again a taxable return. So if I do my post-tax return, it's somewhere around 4.5%. Now 4.5% or 4% is lesser than my inflation. So is my money growing or falling down? Oh, this is one question. Even before even, yeah, I missed out that. Yeah. So before even we consider what options we consider, there is one thing that you should always keep in your mind, that the option should be looked at in a way that it defines, it answers to your question. And the question would be, okay, whether you want to die rich or you want to live rich. Okay. Now, if someone is not able to get me that whether what is the difference between living rich and dying rich, ask me a question in my chat window that Rajesh what it is. And if you have already got my thing that whether you want to die rich or live rich, yes, Nishank, Suman, so smart यार really. पूछने से पहले ही आंसर आ जाता है. Okay, that what it is, what do you really you want to live rich, isn't it? Now, live rich and die rich. Really, yeah, Rahul, I love your answer. Live rich and die rich. Yeah. So, what's the difference between living rich and dying rich, and how it can be? Now, if I'm investing for my retirement, all my if my money as my retirement corpus is into real estate, yeah, plot of lands, acres of lands. Okay, will I die rich or live rich? Die rich. The same thing instead of lot of acres of lands and plots of land, if I have it in the commercial property, a commercial property which I have leased out to a some shopper stop or someone, I have a commercial property and getting rental income. So will I live rich or die rich? In fact, Rahul's, it is your answer, both. I will live rich as well as die rich, isn't it? Similarly, if I'm investing into mutual funds, and if I'm investing into stocks, okay, where I'm able to get my regular dividend, at the same time, I can withdraw the money on through a systematic withdrawal plan every month. At the same time, the value keep on appreciating on my existing plan. So will I die rich or live rich? It's both. Same if I invest into gold. If I invest into gold, gold we will always die rich because there are many people who feel gold is very liquid. Okay. But people who feel gold is liquid, yes, gold is liquid across the world except for India. Now ask me why. The reason is, don't ask me. Go and ask your wife. Can I take out your gold? Sell because the gold rate is very high. I will buy a gold later. Just go home, ask your wife. Gold rates have increased so much. So, darling, can I have your gold? I will sell off the gold now. Okay, let's convert into liquid cash. And then I will again buy when the gold becomes cheap. Go and ask your wife. Then you will get an answer whether gold is actually liquid or not. Gold for our Indians is not liquid because we have a lot of emotional attachment with the gold. So gold is basically a semi-liquid asset for us Indians because it is liquid. It becomes liquid only when you are about to die. When things go beyond your manageable level, no, only then your wife will come out, take out her gold and say, okay, please sell this and get something so that we can sustain ourselves. So gold is always the last resort. So next, rental income. So is rental income. So let's see what I'm trying to say is I'm looking at all the options that are available, pros and cons. So if you see a rental income, so rental income, if you're investing into a house property, okay, the rental yields in the most of the Indian cities have been dropping, and it is one of the lowest across the world. Okay, and if you see in the past few years, both the rental income has become static, and also the capital value appreciation also has become static, and in fact residential. So always remember. So if you're investing, so for your investment purpose, never buy a second home saying that buying a second home, I will get rent. No, the rental yield is only 2% on your residential property. So never invest into a residential real estate. Always invest into a commercial one. A commercial one will give you a higher yield. That is, it would give you 4 to 5% rental income, at least 4% rental income, and also the appreciation. Okay, let me not tell you. You tell me. What do you think? The rent for a residential property would be higher or a commercial property would be higher? A property of the same value. I bought a home at 1 crore and I bought a commercial property at 1 crore. Do you think the rent of the home of 1 crore would be much more higher or the commercial property, a shop of 1 crore would be higher. Which one? You answer yourself. Commercial. Now, in terms of appreciation, when it appreciates, will the residential property will appreciate more, or will the commercial property is likely to appreciate more? I'm speaking about probability. Yeah. Okay. There is always things like future is uncertain, so we cannot never say. But what is a high probability that which one will appreciate, whether the residential property will appreciate or commercial property? Again, the answer is obvious: the commercial property will appreciate. But what happens most of the time when we think of investment, no, I've seen many of my friends, many of our clients start thinking of buying one more home to invest. Just a couple of weeks back, I was advising one of my clients. He already has a house in Hyderabad. Okay. He is now, he has started his business in Mumbai. So he calls me from Mumbai कि राजेश भाई मुंबई में घर लेने का सोच रहा हूँ आप क्या बोलते हैं? Now I told him one thing. Do you really plan to live in that home? Do you really feel that you will settle down in Mumbai? He said, yaar, pata nahi. He said, if it is pata nahi, then till the time you're sure that you're going to live in Mumbai, don't buy a home. If you really have money and if you want to invest into real estate because you feel currently the real estate is available at a very cheap price, please invest into a commercial property so that at least you will get a rental income out of it. And that is what I advise you also. Now, what is the challenge in terms of property? Because in property, one of the major challenges is selling. So you cannot sell whenever you wish. Can you dispose of whether it is a residential property or a commercial property? Can you dispose it of whenever you want? It cannot be. It's very difficult to dispose of. In fact, whenever you're in a dire need, it becomes impossible to dispose of. And it is always a distress sell, and you will have to sell it at least 20 to 25% below the market price. It always hurts you more. Second is the maintenance cost. The maintenance cost is always going to be in a commercial property, it's going to be much more higher. Capital gains. So whatever capital gains you get onto the property, if you sell, you always have to reinvest to save on the capital gains. Else you will end up paying high income tax. So what is the one more option? That is equity. So equity, how you can invest? Direct equity, mutual funds, or buying a unit link insurance plan. Okay. Any day investing directly into equity is the most preferred option. In fact, after post-COVID, I've seen we have witnessed the highest opening of demat accounts. Many people are actually going crazy and starting investment into the stock market. Now, how many of you really invest into stock market directly? You have about 45 plus people. Out of 45, how many invest directly? Geet, Mahimitra, Suman, you invest directly. Okay, I do. Okay. Now, how many of you have learned how to invest into the stock market? Sudhir, you have done, you have learned in, okay. Geet, you did. Good. Don't know. See, one thing. See, if you have to, see, when you didn't know how to drive a car and when you wanted to drive a car, I'm just coming to that only, Sunanda. Exactly, you have got the right point. We just go by others' recommendations, and this is the worst way. You know, equities give the highest return, but 98% of the people, 98% of the people who invest into the stock market lose their money. 98%. I'm not saying, and I'm not joking. I'm really serious. 98% of the people who invest into the stock market directly, they lose money, and they lose money only because they have never learned how to invest into the stock market. Whether you are an investor or whether you are a trader, no matter what you are, you should always learn before you invest into the stock market. And that's what we do. See, if you have to learn, if you wish to swim, what you do you just go and jump into a swimming pool and start swimming on your own, that someone else will, if I die, if I drowning, someone else will come and save me? No, you always learn from a professional. You learn how to swim and only then you go for a swimming, isn't it? If you want to drive a car, do you just take a car keys and just start driving a car? Or you go to a proper learning school or driving school, learn how to drive, and then you start driving a car? What do? You tell me. But so any other thing in our life, when we want to do any new thing in our life, we always first learn how to do that and then we start doing it. But I don't know why investing into the stock market, 98% of the people, they just because it's easy to open a demat account. They just open a demat account because it is easy to get recommendations from your friends, your family, or even from your broker. Once you open an account, every day you will get an SMS from your broker that please invest into this, invest into this. Now they actually say investment, but it is actually speculation because you don't know why you are investing, isn't it? In what you are investing, what the company is into. Have you, so even people who have invested, have you ever seen that what that company is into, what the company fundamentals are, whether the company is really strong? So it is always, so never invest directly into the equities without learning properly. And what you need to learn, always learn fundamental analysis and technical analysis both. Many people feel that only learning technical analysis more than enough. So I'm not sure people who have learned whether they have learned fundamental analysis or technical analysis. I would like a quick response whether you have learned fundamental analysis or technical analysis, or you have learned both. There are about 4 or 5 people who answered that they have learned how to invest into the stock market. So whether you have learned about fundamental analysis or whether you have learned about technical analysis. Technical only. I know technical. First one complete, second one a bit. Yeah. So it is always you have to see one thing. Okay, it is slight deviation from the current topic, but anyway, because we have initiated and because it's now a fancy now everyone wants to invest in the stock market. I feel it's my responsibility to say that if you want to be an investor, and investing means investing after thorough analysis for a long time. Okay. So if you want to be an investor, you have to learn it fundamental analysis. And if you want to be a speculator, if you want to be a speculator that is trading daily on daily basis, buy, sell, buy, sell, buy, sell. If you want to be a speculator, you need technical analysis. But it is always better to have a knowledge of both. And if you then opt for whether you want to be a speculator or want to be an investor. And without learning this technical or fundamental, and if you start investing, then you become a gambler. So you're not investing or trading, but you are actually gambling into the stock market if you do something without learning the both. Okay. By the way, I don't trade at all in my stock market. I always invest. I'm actually a value investor and I teach fundamental analysis. I don't teach technical analysis. It's my partner who teaches technical analysis. Yes, Sunanda, there are so many courses. Even like we also offer a learn to earn course. We do offer a course on stock market. I would share with you later because this is not the right platform. Anyway, you can get the details through Ethika on that. Yeah. Yeah. So the point what I was making is if you have not learned, or if you don't have the patience to learn, or if you don't and feel you are not able to learn, okay, then you should always invest into mutual funds. Don't burn your hands by directly investing into equities. Now, mutual funds also, though it is said that mutual funds sahi hai, there are more than 5,000 schemes available for investment. So out of this 5,000, konsa sahi hai? Even that is also $1 million question. So if you can really, if you know how to, in fact, last previous session we had in the month of June was on mutual funds, but how to select a mutual fund. Okay, so if you really are inclined to understand, if you can understand how to shortlist a mutual fund, how to invest into a mutual fund, then you can go for direct investment to mutual fund. If not, always have a proper advisor who can advise you on your mutual fund and invest into mutual funds. So mutual funds is much more secured. Of course, the returns that you can expect from mutual funds would always be lower than what returns potential you can grow from the direct equity. And the third is unit linked insurance plan. I'm personally not a big fan of ULIPs because somewhere I feel it is always better to invest to take a term insurance and invest into mutual funds rather than to go for a combination of insurance and investment both and invest into ULIP. But of course, I know few of you may be big fan of buying insurance investment plans. But personally, I feel it's actually not value for your money because the costs that are involved into ULIPs or any other insurance investment plan is much more higher than your direct investment when you're investing directly and when you're taking a term insurance separately. So how to choose the instrument? So it is always important. See, the vehicle that you are taking. How much time do we have, please? Because I'm not actually watching my time, so please let me know whenever I need to wrap up because I'm not keeping an eye on much. In fact, I can talk for about 4 to 5 hours at a throttle. I take sessions for 4 hours together. Okay. Yeah. So so before you choose your investment, always keep these 4 things in your mind. What is the safety? The safety of a capital. So whether your capital is safe or not. Liquidity. That how is the liquidity? So you need to always have a proper balance of liquidity. What is the kind of return on investment that you can anticipate, and whether the return is in line with your expected return. I'm not saying any good or bad return, but the return should be more than the inflation, and it should be nearer to your expected inflation, and whether your investment is really tax efficient. So at the end of the day, the return may be seeming you very higher. Like uh, comparison, like if you're investing into an FD and if you're investing into a guaranteed return insurance plan, in FD you would be getting somewhere around 5.5%, and in your guaranteed return insurance plan you would be getting somewhere around 5.75%. So per se, it may reflect to you very similar, but the return that you get from your insurance plan is non-taxable, and the return that you get from your fixed deposit is taxable. So net of tax, the return from my fixed investment would be 4%, and the return from my guaranteed investment plan in insurance would be somewhere between 5.5 to 6%. Okay, so even taxes also needs to be considered. So if I just look at in brief that if you invest into FD, if you invest into real estate, if you invest into real estate insurance, and if you invest into equity. So when it comes to safety of capital, which one is better? When it's come to life cover, where you have tax benefits, that is exempted, where that is investment is also exempted, interest is also exempted, and also the withdrawal is also exempted. Okay, liquidity, whether it is highly liquid or not, reinvestment risk. So when you want to reinvest that amount, whether you can easily reinvest or not, and whether they actually beat inflation. Okay, so if you see in most of the things, equity performs better than even any other investment options. Equity is one of the most, but I would not say you should invest everything into equity. Now there's a formula: how much you should invest into equity, how much you should invest into debt, how much you should invest into gold. So invest into gold should always be somewhere around 5 to 10%, not more than that. Your debt should be equal to your age. So say for example, you are at the age, you are at 30. So 30% of your total saving should be in the form of debt. And the equity and real estate, the combination of equity and real estate should be the balance. So say if you are at 30 years of age, about 5% you should invest into gold, 30% into debt in the sense of long-term debt mutual fund, corporate bond mutual funds. Okay, or your guaranteed insurance plan is also a debt, a kind of debt only. Your chits, the chits that you invest, that is a debt, but chits are all short-term, not long-term. So 30 and 35%, and balance 65% you can invest either into real estate or equities. And always remember, don't invest more than 40% in any single asset class. Like if you are investing like out of 65%, if you're investing into equity, don't invest entire 65% into equities. I would suggest if you can, because if your investment becomes big, see initially when you are investing into mutual funds, SIPs and all, you cannot invest both into real estate and this thing. So you will have to slowly start building up your wealth by investing into mutual fund or directly into equity, small amounts. At that time, your entire, but the moment you make it a considerable wealth, say about 50 lakhs, 60 lakhs, or about crore money, then what you should try to do is try to diversify a bit into real estate. So you should diversify into real estate only after you receive a considerable amount of money. Don't start diversifying by immediately. Yeah. So how can we support? So let me say, how can we support, like through Ethica? How can we support? Is uh, we can always help you in making a holistic financial plan by duly considering your annual saving potential. So how much you, not how much you are willing to save or how much you are saving, but how much you can actually save or how much you should save. So we always by analyzing your income and expenditures, your EMIs, all those stuff we analyze, and then we guide you on that what should be your saving potential. We try to look into and make you present to that what are your key financial goals, because people just look at one or two financial goals, but what are your key financial goals, at least for the next by the time you achieve 70 or 80 years of your life. Then categorize these goals based on the priority and the timeline. So like for example, like for child education after 13 years, maybe 1 crore for the child education after 13 years, 2 crores for my child marriage after 18 years, retirement for my retirement, about 10 crores of my 10 crores corpus. So that is how we start to prioritize and learn. Then we curate an investment solution comprising of combination of insurance, mutual funds, debt, real estate, and equity. So we always try to see that, okay, how should you try to combine and balance between both. So we do the review of your existing investments and then suggest that what should be your future investment plan or how you can realign your existing investments. Okay. So these are some brief sessions, some glimpses of the sessions we have taken. So yeah, so I request you all to kindly join the Financial HiFi Club if you have not joined. So this is a WhatsApp group that has been created by Ethica Work Life. So to keep you appraised about financial thing, it's a platform where I personally address the queries on various financial aspects that people post. Even future sessions details are also posted in that group. So anything and everything about financial planning is available. The queries are available in that group. So if you really uh, can someone post the link for the WhatsApp group here in the chat window, or will it be shared later?
After the session, I will be sending a mail, sir.
Okay. So after the session, you will be getting a mail with a link to join this Financial HiFi Club. Club. So I would request you all to please join that club. So the platform is open now for any questions. Any questions? You can either write it into the chat window or you can unmute yourself and ask me.
Hi Rajesh, this is Nishank. Can you hear me?
Yeah.
All right. Rajesh, my question to you is on medical and health insurance risk covers these days.
Okay.
When you pay a fraction of a cost, like you get these 1 crore risk covers at the price of 6,000 annually. So what's your take on that? And how much cover is sufficient, at what age, is some of the aspects that I'd like you to touch upon.
Okay. See, when it comes to medical cover, there is a thumb rule which you should always take up is one thing, always go for a split of both your base policy as well as a top-up policy. You try to split yourself, your cover into first is your base policy, second is your top-up policy. Now, base policy, you should go for anything between 5 to 10 lakhs, depending on your own affordability, what you can afford. I recommend if you can really afford, go for 10 lakhs. Don't compromise on that. Even you may be covered under your and if you're already covered like your by your organization mediclaim and all, still you take a base policy of 5 lakhs minimum, your personal policy of 5 lakhs. And if you're not covered by your organization recently, then go for a 10 lakhs base cover. And then as an add-on, currently the top up that is available is almost like 20 to 25 lakhs top up is available at a very less cost. Like a 25 lakhs top up over and above a 10 lakhs policy would cost you somewhere around 4 to 5,000 bucks. That's it. So I would always suggest a combination of 10 lakhs as a base policy, minimum 5 lakhs. So either 5 plus 25 or 10 plus 25, 10 plus 20. So about 30 lakhs cover would be more than enough as on date. Now in future, because why I say as on date it is more than enough is, see, at 5 lakhs, 80% of the claims, I was sorry, 90% of the claims are less than 5 lakhs. Only in less than 5 to 8% claims more go beyond 5 lakhs. That would be somewhere like your very fatal accident you meet about, or there is some massive organ transplant or some vital organ failure like your liver failure or your heart bypass surgery. It goes beyond 5 lakhs. So in that case, if you are insured by about 25 to 30 lakhs, that would be more than enough, except for some vital organ, because most of the organ transplants also cost you somewhere around 20, 25 lakhs. Okay. So 98% of your claims would still get covered under this 25 lakhs. There would be a rare 1% scenario which may cost you beyond this 25 lakhs. Okay. Yeah. And in terms of term insurance, I would recommend that term insurance cover should always be in line with your existing annual income. So if your existing annual income is say about 10 lakhs, if you're earning 10 lakhs, then your term insurance cover should be minimum should be 10 times of your 10 times of your annual income. That is 10 lakhs, 10 times of 10 lakhs, that is 1 crore. Recommended would be 17 times, that is 1.7 crores. And the maximum that is offered by insurance companies is 25 times, that is 2.5 crores. on an annual income of 10 lakhs. So 10 times is the minimum, 17 times is recommended, and 25 times is the maximum that is available. Okay. Now there is one question which I saw that Surendra has asked is, yes, Surendra, emergency fund, there should be minimum 6 months of liquidity. Yes, this we did covered about a couple of months back when we were having a session called Be Your Own Financial Planner. So one thing was about emergency fund. So this emergency fund, when you are saving into emergency fund, uh, don't keep your emergency fund into savings account. Okay, your savings account, so always divide the 6 months into 1 plus 5. So your 1 month expenditure should be there in your savings account, and the 5 months expenditure should be into liquid fund or ultra short term fund. Don't invest into long term debt fund. I would recommend you invest into a liquid fund, else a short term debt fund. Yeah.
You said ultra and short term.
I said liquid fund and ultra short term funds. Short term or ultra short term funds, both are ways. Like short term fund, in fact, we a couple of months back we did had a session on how to identify debt mutual fund. So one of the ways, uh, can you that get quickly your money back? Yes, it's you can withdraw it in 2 working days. You redeem today, you will get into your account in just 2 working days. My mitra. So that 2 working days, that's more than enough. And that's why I said 1 month should be there in your savings account, and the balance 5 months you can keep it in your liquid funds. So I said liquid funds are ultra short term debt funds. So ultra short term debt funds are for a tenure of less than 6 months. So they invest into a government treasury bonds or only commercial papers which are expiring in the next 6 months or 1 year. Yeah. Any other query? Any suggestion for the next session? Because we have one session every month. So any suggestions you have, that any requirement you have for the next session, you want me to take on any next session coming, any topics, you can either post it here, or you can even be a part of the group, and you can start posting into that. Okay, stock market investment, sure. Okay, so Git +1 is for stock market, I presume. Okay. Yeah, okay.